When a market breaks out into a massive trend, retail trading bots fail. They hit a rigid, pre programmed limit, and the market simply shatters it. The issue lies in their reliance on static technical boundaries. The vast majority of these automated systems use fixed relative strength index, specifically the standard 30 and 70 levels, to trigger their entries. This creates a mechanical trap. As we see in this chart, when price rockets upward during a breakout, the RSI line flatlines out the 70 boundary. The bot reads this as overbought and drops a short entry right in front of a runaway train, immediately pulling the position into deep negative territory. To survive severe market volatility like the sharp, unpredictable crashes we saw throughout October, an algorithm requires real algorithmic plasticity. It needs the capacity to learn from its immediate environment and rewrite its own execution rules in real time. This brings us to a specific piece of architecture of 5-line Python hedging bot designed to weaponize that plasticity against the market. Looking directly at this bot's terminal output, we can see it actively abandoning static levels. Focus on this specific string calculating a dynamic boundary, showing how it adjusts its parameters on the fly, based entirely on the position's current status. Surviving volatile crypto environments doesn't require hunting for a perfect entry signal. It requires engineering a 3-layer architecture built on dynamic adaptation, mathematical position laddering, and systemic hedging. The first layer of this architecture is built entirely around recognizing the state of a trend before ever executing a trade. The trigger mechanism is calculated through exposure. If the bot realizes it cannot close a position on one side of the market for an extended period, it identifies that it's trapped in locked trend. Instead of waiting for primitive indicators, the system recalculates RSI boundaries. Watch how this upper boundary detaches from 70 and shifts into a new zone between 60 and 80. As the RSI touches 60, the system fires a long entry to ride upward momentum. Trading directly with the prevailing trend carries secondary mathematical benefit. It rapidly accelerates the closure of older trapped short positions that were lagging behind. Once those positions clear and market momentum normalizes, the system initiates a cool down phase, allowing the dynamic boundaries to gradually return to a more static state. Yet, because the underlying algorithm is built on machine learning principles, it remains constantly primed to shift those boundaries again at the exact moment the next volatility spike hits. This approach strips out the inaccuracies of standard exponential moving averages, which carry inherent lag and regularly produce false breakouts. Dynamic thresholding prevents the kind of counter-trend liquidations that wipe out retail accounts. The bot flows entirely with market momentum rather than blindly fighting it. Once those dynamic boundaries trigger valid signal, the second pillar of the architecture takes over: trade execution. The system completely abandons binary all-in entries, viewing them as an unnecessary risk to capital. We can see this internal risk management logic mapped out in this JSON configuration code. Notice lines 36 through 39 tightly dictating the take profit percentages and scaling factors. It enforces a strict capital limit. The bot factors in the global take profit, the percentage, and actively restricts itself from ever deploying more than 70% of that allocation at once. Instead, it relies on mathematical laddering. Capital is deployed in calculated micro portions as market conditions evolve. An initial small block of capital is deployed high, followed by successively larger blocks placed at lower intervals. The core logic hinges a specific scale factor. When older portions lag, the bot calculates and adds new portions. Each added block violently pulls the average entry price down, forcing it closer to the live spot price. The algorithm dictates strict timing rule. The greater the distance between those older portions and the current price, the faster the bot executes this distance closing math. Because the bot operates on scalping principles, it actively buys itself the necessary execution time to manage and resolve these multiple portions before hitting its global threshold. Mathematical laddering ultimately translates raw market volatility from liquidation threat into a calculated mechanism for forced profit extraction. The final pillar of the system is designed to protect the macro portfolio from isolated asset failures. Traditional scaling usually involves deploying 10 identical bots across 10 different assets. That still leaves the entire portfolio vulnerable to a universal market crash. The solution is generating entirely heterogeneous trading profiles for every single asset parent monitors. Looking at the terminal, you can see a base allocation of just 0.07% alongside a generated list of highly distinct profiles. These variables change drastically per asset. One bot is configured to trade aggressively a fast 1 minute time frame, while another operates a balanced, conservative 15-minute chart. It even runs extreme variations using inverted logic setups. Notice the configuration flag setting inverse to yes and utilizing full closed modes specifically designed to hedge against the behavior of a neighboring bot. These bots operate entirely independent of one another. They close positions at varying times and continuously recheck the global balance percentages before executing new ladder. This requires enforcing strict risk cap, allocating maximum of 0.05% to 0.07% of the total balance to any single bot. From the outside, the system's trading behavior appears completely randomized and uncorrelated, making it impossible for the market to counteract. These heterogeneous profiles essentially construct an internal hedge fund structure. Even if one asset becomes trapped in a massive drawdown, the aggregate profit generated by the other unique profiles covers the risk. Transitioning from the localized logic of a single pair, we have to look at what this architecture achieves a macro scale. This live terminal dashboard demonstrates that exact operational density, managing a $10,000 allocation with 86 active ladders operating across 12 unique profiles simultaneously. To read this output, focus specifically on the partial LS and partial P&L columns. This is where the mathematical ladders track our EAL time profitability across multiple pairs like 1000 bunk and render. The long-term viability of this architecture is validated by the aggregate net profit data. This performance report shows highly consistent net profit columns running continuously from February through July. Maintaining this kind of density requires specific infrastructure. A 5,000 line Python execution environment cannot run casually in the background of a personal laptop. It demands deployment a dedicated Linux virtual private server to guarantee 24/7 continuous uptime without about the risk of local hardware or network failure. The centralized exchange itself requires specific configuration. It must be explicitly set to hedge mode to allow the bot to manage opposing long and short positions on the exact same asset simultaneously. Finally, it requires strict API IP whitelisting. This double layer security ensures the exchange only accepts commands originating from the exact IP of the dedicated Linux server, merging dynamic threshold metrics mathematic. Microladders and strict server security consistently yields results, often generating 8 to 16% monthly returns, precisely because it completely removes human emotion from complex execution. True algorithmic dominance is never achieved by hunting for a static holy grail indicator. It's built entirely through an architecture of relentless automated risk adaptation.